Hello and welcome to the CNBC-TV18 Mumbai newsroom. I'm Sonal Bhutra and with me is Patra Parekh, and this is the first mutual fund corner of the new year. And we've been talking about how 2022 has seen a lot of volatility, Patra. Despite all this, Indian markets, they held their ground and fared much better than the peers, right?
Yes.
The other markets as well. So how does all of this look like for the mutual fund industry? What should be the approach for mutual fund investing in 2023? That's what we're going to talk about today.
So that throws up a lot of questions for our guest. Let's welcome him then. Harshvardhan Roongta of Roongta Securities joins us now. Harshvardhan, a very good afternoon and thank you very much for joining us. I'm Pavitra and, like Sonal was just pointing out, this entire past year has seen so much volatility, but we have spoken so much about how mutual fund flows have been good. We've seen good flows into the industry and, of course, how the Nifty has also fared much better than its peers. What this, throws up now is that in the coming year, where do you expect the strength from the mutual fund space to come? What are the sort of sectors within this space where you think that, that we could see a good outperformance from?
Hi, Pavitra. Thank you for having me on the show. If you see the economies across the globe, they continue to be volatile. I mean, the factors such as inflation, rising interest rates, the geopolitical tensions that we see, such as the Russia-Ukraine, these continue to be going further into 2023. And in fact, I don't think anybody would in a position to guess as to when they're going to be, sorted out and by when and how they're going to be sorted out. And most importantly, Pavitra, I would say this, that even if these things were to get sorted out, I mean, even if you look at a situation like a high interest rate coming under control, I mean, inflation coming under control, the Russia-Ukraine problems getting solved, there always will be something else that will crop up. It's a global issue that we're talking about, all economies being interlinked. There is always going to be some situation which is going to keep the markets on the edge. I don't remember in my history of being into markets that even 1 year has gone by where there has not been any kind of uncertainty. So uncertainty is going to be here. Volatility is an integral part of markets, and they're going to be here. So I don't think we should look at a perfect situation in any case. Now, when it comes to investors, that's what you're asking. I mean, what should investors do? Which sectors should they look out for, etc.? I would say, let's assume the situation is going to remain as it is. We have to find peace in the chaos that is happening. How do you do that? As an investor, asset allocation is the one solution that every investor can inculcate in their portfolio. Now, how would you do that? I mean, it is how much will you allocate to equity and debt, depending on so many other factors that affect you personally. Within equity, what I will suggest is that you allocate about 50% towards large caps, 30% towards mid caps, and 20% towards value-oriented funds. So I think you will be able to get the benefits of equity, at the same time manage the global volatility that we're seeing, or probably a recession that we're going to be looking into in 2023.
Okay, get that point. And also because we are talking about volatility that could continue, it's a question of not if, but when and what will happen. So when you speak about a 50% allocation that should happen to large cap funds as well, there have not been many of them which have been able to beat the benchmark last year. Do you think this is a category that will make a comeback this year, and that's why you think majority of the proportion of portfolio allocation at least should go here?
Sonal, within the large cap category, I think it's amply clear now that passive funds are a better option when compared to actively managed funds. I mean, we look at data and we will know that very few large cap funds have been able to beat the benchmark. So I think we are very clear on that. The verdict is out saying that if you're investing in large caps, the index or a passive fund is a better option. Now, I could suggest two options, two further deviations from this pure index fund. One would be an equal weight index fund. However, the other option would be a flexi cap fund. So flexi cap fund, I say so because majority of the allocations in all the flexi cap funds are essentially large caps with a small allocation towards mid and small caps to generate that additional alpha that we're talking about. So, if you talk about equal weight index fund, a very interesting product. So equal weight Nifty index fund would be like this, that the constituents of the Nifty, like all the 50 companies forming a part of the Nifty, will remain the same. Just the allocation will differ. So while a Nifty 50 would have Reliance allocated at about, the allocation of Reliance weightage being about 12%, in this equal weight index, it will be 2%. So all 50 companies will be equally weighted at 2%. Unlike a traditional index fund, which would have 13% of Reliance and all other accordingly. Now, back testing data, we've seen that, this manages the volatility better and has the potential to generate higher returns over a longer period of time. So that is one option that I thought investors could consider going further in 2023, where you have an equal weight index.
All right, that point is completely well taken, and this is how you could approach large caps if you want that kind of exposure in your portfolio. You know, Harshvardhan, the next space that we want to talk to you about is debt funds, because, of course, I came across this very interesting piece in the US about how the preference for debt versus equity has rarely ever been this high. So when we are talking about high interest rates and how this will continue to sort of ensure traction in this category, now with the expectations that hikes perhaps will not be as high or they'll be paused, what do you think is going to happen in this category in terms of flows? And also, the next question is that would you look at debt funds or would you look at FDs in this case?
Pavitra, I mean, why the increased interest of people in debt funds. So if you take into consideration the volatility, the risk an investor takes into equity funds and generates a return of, say, an assumption of about, say, 12 to 15% kind of return, wherein the past 1 year returns or 3 year returns have been slightly towards, in double figures, I mean, just a lower double figure kind of return. Now, the investor gets an option to earn a high single digit return in a debt instrument. What is the motivation for a person to take that incremental risk to generate only a few basis points higher returns in equity? So that's the essential reason why people have started moving towards debt. However, if we believe that interest rates are at their peak and are unlikely to go up further, so this is a great time for investors to park their money and lock themselves into the portfolio yields that we're getting. So currently, the portfolio yields of any mutual fund would be around 7 to 7.5%. So if you park your money right now, you're kind of getting yourself an assurance that you'll get between 7 and 7.5%. Now, comparison between debt funds and fixed deposits. Now, I take cue from what you said, like in case interest rate hikes are going to be paused, and if they start correcting, they start coming down, there is a possibility of capital gains that you can earn on your debt mutual funds, because the interest rates and prices of bonds are inversely related. When interest rates start falling, you see the prices of bonds going up. So the investor will also make a capital gain, which unfortunately is not the case with a fixed deposit investor. I mean, once you freeze into a product, even if interest rates go up or down, you're going to get that kind of returns only. Further, the last benefit that you would really see with mutual funds is the way they are taxed. The returns that the investor gets is taxed. So there is a long-term capital gains in case you hold your investment for more than 36 months. And with indexation benefit, the tax liability comes down considerably when you compare it to a fixed deposit. Fixed deposit interest is taxed at your marginal rate of taxation. So these are, a few comparable points where it makes far more sense to go for a mutual fund and invest in a debt fund to get the benefits of elevated interest rates, the capital gains, the liquidity, and the preferred taxation. Target maturity funds in this category are one of the products wherein if an investor does not require regular cash flows, then it has an horizon of 3 years, 5 years. You can lock your money into a target maturity fund where you'll get higher yields as of today with indexation benefits on maturity.
That is a great explainer as to how you can just look at the debt funds right now and how it would compare with fixed deposits as well, because that has been an investor favorite for some time as well now. While we've spoken about how large cap funds would be this time around, could this be a year for small cap or mid cap funds as well, Harshvardhan? What will make them more attractive versus the large caps this time around? Because we're talking about them, being valued at lower levels right now.
Yeah, you're absolutely right, Sonal. In fact, if you look at the 10-year average PE of the mid cap, small cap, and large caps, you'll see that mid and small caps are actually trading lower than their average 10-year PE. So, it is one indication to say that, there is a good entry level. And large caps, on the other hand, are trading at a premium to their 10-year average. Now, if you look at this purely and think that mid caps look attractive, well, I would like to put it in context with what is happening globally as well. So why would people look at investing into large caps? The primary reason being, if there is global uncertainty, large caps are able to weather that storm better. They are financially stronger. They have a larger moat. They are the market dominance. They have market dominance in the economies that they work. So investors find comfort into companies which are large cap during extreme volatility in the market and extreme uncertainty globally. Now, if you're looking this same scenario to continue in 2023, then again, large caps will be playing out better because if there is any correction, if actual fears translate into some real life problems, then again there will be solace into large caps. So merely being undervalued or rather trading at a lower P than the 10-year average, does it make it attractive enough? I don't think that would be the right way to evaluate. You have to look into what is the global scenario, what is the valuation, and then try and merge both to find some connection. That's why I said 50% in large cap, 30% in mid cap would be an ideal situation where you'd like to also benefit from lower valuation.
All right, we get that completely. Another space that we want to talk to you about, and one that we don't actually discuss very often, is REITs, or the Real Estate Investment Trust. There were no big fundraisers from this category in 2022, but residential real estate has been doing quite well. It's something we've spoken about a lot. But do you think the higher interest rates that we were just speaking about earlier as well, do you think that sort of takes away from commercial real estate and sort of keeps it a little bit unattractive right now? And what would you think is the category for the REIT, the outlook for the REITs category right now?
Well, Pavitra, if you look at REITs, they're very clearly placed between a fixed deposit or rather a debt fund and an equity. I would say, the risk-reward ratio, if you have to look at, I mean, this is a product which fits in just between the two. So from a risk point of view, it is slightly higher than a debt fund, and from a rewards point of view, it will be lower than the equity side. Now, this fits into an investor's profile who's not happy with debt funds, who says that I don't want like a 6 to 7% kind of a return. I want something more. Then, of course, this fits into that category. Now, if you look at the outlook, well, of course, we've seen that last 1 year has been extremely bad and subdued for the REITs. Returns have been, I think, almost negative or just about, flat. Now, with the lockdown, the COVID-induced lockdown getting over, economies opening up, the commercial real estate is also picking up, and that essentially forms the portfolio of the REIT. So I think going further, certain part of allocation can be given to REITs, about a 10% of your portfolio. But I don't think you can entirely bet your entire debt allocation or that that risk capital into REITs as of now. I think a 10% allocation should be good enough to REITs as of now.
So that's an interesting take because real estate has been the flavor, but as you said, these funds have underperformed in the year gone by. Harshvardhan, we'll just get into a quick commercial break and we'll continue this conversation on the other side. Stay tuned.
Welcome back. You're still tuned into Mutual Fund Corner, and we still have Harshvardhan Roongta with us to talk about the 2023 outlook for the mutual fund industry. Harshvardhan, we were just discussing all of these different categories. The next one I want to ask you is about gold ETFs. How do you look at this space? The flows were really all over the place. We actually did a show on just the gold ETFs, and you're trying to make sense of what the flows were looking like. But how do you think 2023 will pan out?
Well, Pavitra, gold, if you were to believe the market experts, commodity market experts, I mean, the outlook for gold looks very positive for 2023. And essentially, again, taking cue from where we started saying that there is global uncertainty, I mean, gold then becomes a safe haven. So in that context, the outlook for gold looks positive despite the 15% kind of a returns that it has generated in 2022. Now, when we look at whether you should invest in gold, yes, even otherwise, whether the outlook is good or bad, we normally suggest that a person should invest about 10% of their portfolio into precious metals, commodities. Now, gold being one of the most popular one and as a hedge against inflation. So 10% of the allocation would definitely be into gold. And the form of investing into gold, the paper gold format, the sovereign gold bonds being the most superior form of investing into gold, followed by gold ETFs and then gold funds. So yes, I would say the allocation should be there, and owning it in the form of paper gold becomes very convenient, tax efficient, etc. So I would see and suggest that everybody does invest some bit in it. What is the outlook? How much returns are you expecting in the next 1 year? It's anybody's guess, but looks good given the global uncertainty.
Okay, so could be a sparkling year for gold as well. But we are also looking forward to, amongst a lot of other global volatility, the budget announcements. That is something that could be a game changer because AMFI has put out a wish list. There are a number of points that they've highlighted as well. What do you think is the immediate change or modification that is needed in the tax regime or other regulatory processes when it comes to the mutual fund industry and different categories?
Well, Sonal, when you look at any two different products being offered in the market to investors, there has to be some kind of parity between the two. There cannot be a tax arbitrage which favors one product against the other. So I think one of the most important suggestions that AMFI has made in their wish list is about bringing about tax parity within the ULIPs, the unit-linked insurance policies and mutual funds. So why you see that if you're investing in a ULIP policy, the structure of investing is the same as that of mutual funds. Provide just additional part being ULIPs are offering you a life cover in addition, for which they're charging you separately. So if the basic structure of investment is the same, which is holding units, investing into equities, balance or debt funds, etc., a person investing less than 2.5 lakhs in a year in an ULIP policy continues to get the returns being completely tax-free on maturity, whereas in mutual funds, they're going to be taxed. Now, this parity, this disparity is not ideally good for any industry. So there has to be parity between the two. And I guess there would be some kind of announcement in this direction. If you take it one step further, once you invest into a ULIP, they have different options. You will have equity, balance, debt. You'll have different kind of fund options. When a policyholder switches between these options, there is no tax implication on the investor, on the policyholder. Whereas the same implies a tax implication on the unit holder if it's in the form of an investment in mutual. So I think there has to be some parity brought about between the two. And I think that is what would be one of the things to look out for in this budget particularly. I also think there is going to be some kind of rationalization in terms of what is the definition for holding period for long-term capital gains, short-term capital gains, because a listed equity is 1 year being the holding period for long-term capital gains, unlisted being 2 years. There are different parameters for different securities in the debt segment as well. So I think there will be some kind of clarity coming in from that. That is what ANSI has asked for, and I guess this should be addressed in this budget.
Yeah, this is something that's been on every single person's wish list as far as the budget goes. So let's see if that comes through or not. Harshvardhan, we've also got some queries coming in from our viewers. So if you could just, take a few of those up. The first one comes in from Rohit Gupta, who's written in from Hyderabad. He says he's investing 6,000 rupees in the SBI Blue Chip Fund, 5,000 rupees in the Axis Blue Chip Fund, and 5,000 rupees in the UTI Nifty 50 Index Fund per month, among some other funds as well. Those will be on your screen as well. He says he wants to know if he should continue to invest in these funds or should he make any changes to these. Harshvardhan, take us through how you look at this portfolio, because the first thing I'm noticing is that there's way too much of the large caps. It could just lead to some kind of concentration here.
You're right, Pavitra. So, if you look at the number of schemes, you will notice that the large cap, you have about 3 schemes in large cap, 3 or 4 rather in that sense into large caps. If you look at the percentage allocation, it's not alarming. So while we were talking about 50% being allocated to a large cap, this is more or less in alignment to that. So very clearly, yes, there is a need to consolidate the portfolio. There is no real purpose being solved when he has 3 or 4 large cap funds. It's all going to give you the same kind of performance, just that you have different fund houses and different schemes to manage. So my suggestion to him would be that he stop his investment into SBI Blue Chip and increase that 6,000 into UTI Nifty 50 Index Fund, which he already has in his portfolio. The other change I'll recommend is a stopping of Axis Blue Chip Fund and increasing that amount into Parag Parekh Flexi Cap. And essentially, not to say that SBI Blue Chip or Axis Blue Chip are not good schemes. It's just that for the purpose of consolidation, we're trying to make his portfolio concise. It becomes easy administratively. Rest of these schemes and allocations are fine. You can continue as
Okay, thank you for that, Harshvardhan and Rohit. I hope that answers all the queries that you had. The next one is coming from Mr. Anand Desai, who is writing to us from Mumbai itself. He is 49 years old and has been investing 20,000 rupees per month each in Axis Small Cap, Mirae Asset Large Cap, and 50,000 every month in PGIM India Flex Cap and ICICI Pru Nifty 50 Index Fund. He wants to continue to invest but wants to know if his portfolio requires any addition here. Harshvardhan?
Well, the portfolio looks fine to me. I don't see any problem there. Just that he needs this money after 5 years. So my only suggestion would be that he keeps a close watch onto this portfolio, and 1 or 2 years before he requires the money, that is, say, probably 3 years from now, he starts gradually moving his money from equity to debt, only to insulate himself from the last moment volatility in case everything goes fine. And just before he needs the money, there is extreme volatility in market crashes. You should not miss out on that, the requirement for his money. So start moving gradually from equity to debt. After 3 years from now, gradually into debt to insulate himself from last moment volatility.
Okay, just let's try to squeeze in one final question. This comes in from Aditya Bodhi, who writes to us from Chennai. He says he's investing 1,000 rupees per month in the HSBC Midcap fund. He also is looking at the L&T Midcap Mutual Fund. And considering the fund's recent performance, Aditya says that he's reduced his earlier SIP amount, which was 5,000 rupees, and he's brought it down to 1,000 rupees now. He says he has accumulated over 5 lakhs and he now wants to know what he should do, whether he should, stay invested in this, maybe look at another fund as well. How do you look at this fund, Harshvardhan? He said the HSBC Midcap Fund.
So, well, Pavitra, the L&T Midcap, L&T and HSBC have merged. So, basically, all the schemes of L&T have gone into HSBC. Now, it is true that HSBC Midcap Fund isn't the best performing fund in the category. However, since he's already been investing, it has a corpus of 5 lakhs. Any changes that he makes right now, there will be tax implications. So I suggest just give this fund some more time, observe it for another 6 months, and in case you still believe that this fund is not doing well, then most certainly you will want to bear that cost of taxation, whatever, and then still move to a better performing fund. So I think make no changes right now, look at it for 6 months, and then decide what to do after 6 months.
Okay, all right. Harshvardhan, thank you so much for answering all those queries. I'm sure the viewers who had written did get that satisfactory expert opinion that they really wanted. Thanks a lot for joining us today and speaking with us. So that's all about mutual fund investing in 2023. And with that, it's a wrap on this edition. But stay tuned. Closing bell will come and we'll take all the last hour trading action for you.